Welcome back to Money Pop. In today's video, I want to share with you exactly what I'm doing in the stock markets right now, because the way I'm investing today is quite different from what I would normally be doing. And this is not just theory or hypothetical talk, this is what I'm doing with my actual real money on the line. To begin, I want to give you my broad sentiment for the long term, because this part is very important for you to understand. It is my firm belief that we are going through what I call the great melt-up. So, if you have been following me for the past few years, then you already know I'm going to tell you I told you so. I made the argument that the stock market is simply going to keep on going up and that it is going up by design. So how did I know this? How did I know the market would just keep climbing? My explanation was very simple and anyone can understand it. The root problem is political greed and corruption. That is the issue at the very source of all this. Because of political greed and corruption, politicians do not care about the fiscal budgets for the government. This has been leading to, and will continue to lead to, constant government overspending and fiscal deficits. This has caused a debt crisis for the federal government. Essentially, the government has accumulated more debt than they can ever pay back. I want you to know that the government is at a fork in the road with two options ahead. Option A, the government can default on its debt, which means they tell everyone they borrowed from, sorry, we cannot pay you back. Of course, if they did that, it would cause absolute chaos. Or they can go with option B. Option B would be the government printing a ton of money. We are talking about trillions of dollars. By doing so, they can pay back the people that lent them money. It is my belief, which I explained in depth in my previous videos, that the government and the Federal Reserve are going to go with option B, printing money. Print money, prevent the disaster. Politicians and central bankers keep their jobs, the stock market continues to go up, and they deal with inflation later or let the next politician handle the inflation problem. When they ramp up inflation by printing money, prices are going to go up. Value will not go up, but prices will. So which prices are going to rise? I would say just about everything. Food prices, home prices, vehicle prices, insurance prices, you name it. Also stocks, precious metals, and financial assets are going to climb in price as well. They will not be excluded from inflation. In a nutshell, what I'm saying is that they will support inflation and everything is going to keep moving higher in the long run. So we are in an everything bubble. In my opinion, it is in everyone's best interest to stay invested in the markets and ride the inflation wave higher. If you do not, then you're going to get left behind. But here's the dilemma. In the long run, it is obvious, at least to me, that the government cannot repay its debts. So they are going to use inflation to monetize the debts. What do I mean by monetizing the debt? Let me give you a quick example. Let us say you make $100,000 a year and you buy your home with a $300,000 mortgage. Over the next few years, inflation gets out of control. The price of a home, on average, goes up by 10 times, but your income also goes up by 10 times because of inflation. So now, instead of making $100,000 a year, you make $1 million a year. Suddenly, that $300,000 mortgage you took out looks very easy to pay back. That makes sense, right? You're inflating the debt away, you're paying off those old debts with devalued or inflated dollars. It is going to be the same with the United States government and its debts. They are using inflation and money printing to their advantage to more easily pay back old obligations. Now, going back to the dilemma, in the long run, the Federal Reserve, the central bankers, and the government are going to continue printing money. They are going to continue inflating, and we are in an everything bubble where prices keep moving higher. However, in the short run, we are facing a potential energy crisis because of the Strait of Hormuz. That situation may throw us into a quick and nasty recession and a violent stock market crash. So the dilemma is this. We know the market is going to keep going up in the long run. However, in the short run, we may be in for a nasty dip, and that could become an amazing buying opportunity if the market does crash and gives us the chance. Here's how I'm interpreting the situation. If oil spikes to $150, $180, maybe even $200 or more a barrel, then in my opinion, it will cause a recession. And this will pressure the stock market lower if there is no government intervention. However, as I mentioned in my previous video, our governments cannot afford a recession, or at least not a prolonged one. So there will be government intervention, there will be stimulus, and I do not expect the government and the Federal Reserve to dilly-dally. They will be on top of this very quickly, even at the mere threat of recession, and they will be ready to stimulate. It is my belief that this would lead to a V-shaped recovery in the stock market if it does crash. With that being said, given my interpretation, what are my options? I would say I have three solid choices. The first option is to simply stay invested and do nothing. The thinking is that long term, the market is going to keep climbing. If that is the case, who cares what happens in the short run? If the market crashes, just take the hit and weather the storm, because we are focused on the long-term picture. Option 2 is basically trying to time the market. You sell your stocks now, you hope for a stock market crash, and you hope to rebuy at a lower price. The plan, if you go this route, is to time things perfectly, sell at a good time, and rebuy at a better price. I will tell you, most likely it is not going to go according to plan. Personally, I'm not even thinking about going this route. I believe timing the market is just wishful thinking. But hey, that is just me. Do not let me discourage you. If you think you can do it and you're willing to give it a shot, be my guest. The third option is to stay invested and hedge your positions. I am personally choosing this route. I'm staying invested, but I'm hedging my portfolio to play defensively. Given the current environment with the Strait of Hormuz, I truly believe what I'm doing is the most responsible approach. It is not guaranteed that oil prices will spike, but I will tell you it is not far-fetched at all in my opinion, given the circumstances. So I'm staying invested primarily in the S&P 500, in gold stocks, silver stocks, and copper stocks. But as you know, if you watched my previous videos, I have also invested in oil as a hedge. My plan is very simple. If the price of oil spikes and crashes the stock market, I'm just going to sell my oil for a big gain and use that money to buy stocks, precious metals, and other assets that have fallen during the crash. You buy low and sell high. Normally, I would not do this with my portfolio. I normally do not carry a big hedge, but I'm truly concerned about the Strait of Hormuz right now. That is just my honest opinion. Another thing I'm doing differently is that I'm accumulating a cash position. Normally, I would have the vast majority of my money invested, about 90 to 100% of my portfolio, because of the great melt-up. I do not want to lose to inflation. However, right now, at least in the short term, we are facing some unique circumstances where having a larger than normal cash position is completely understandable. At least to me, the purpose of holding more cash right now would be to buy the dip if that opportunity presents itself. So I have sold some non-essential positions for a gain. I have not reinvested dividends. I have sold some covered calls. Right now, I'm basically stockpiling cash, and I have hedges in place to produce additional cash if the market takes a turn for the worse. So I'm preparing for a bad scenario. I'm not at 30% cash yet, but ideally that is where I'm trying to head. I just want to clarify, going back to our options, I do not think it would be a bad choice to do nothing and weather the storm. If you are a long-term investor, that is perfectly fine. Personally, I just want to be able to capitalize on the buying opportunity if there is a stock market crash in the months ahead, which is why I'm choosing to stay invested with hedges in place. Thanks for watching. This is Money Pop signing out.